Thank you, Lynette. Well, we'll get started this morning. We're going to build upon last Tuesday's or the 2 days ago's presentation. We'll get a little deeper into the subject matter, spend a little more time on the terms and things like that to give you a better appreciation for how things are to work and the documentation that you'll need for your agent. So with that, just an objective here, just restating what I'd said was create a deeper understanding of the documentation required to support the information you report on your forms for determining your whole farm guarantee. We're going to just jump right into here what we're going to cover. Similar to what we did before, we're going to talk about 3 main categories of information. We're going to dive into the policy a little bit deeper than we did the other day. The documentation, we'll talk a bit about what verifiable records are, and if you're a direct marketer, kind of a couple of aids, bookkeeping aids that RMA has developed for you. And then finally, we'll end up with an example. I just took a simple example of how the inventory accounting works for a cow-calf enterprise. So here's an acronym refresher, just in case you'd forgotten some of them. We'll deal with some of these today. Obviously, the AIP is who your company is, the insurance provider there. Federal crop insurance, this is a federal crop insurance product. The farm operation report, that's very integral to determining your guarantee for whole farm. It's your acreage report, it's part of your application, it's part of your production reporting at the end of the year. Intended farm operation report, as we talked on Tuesday, that's the first step in the process. Internal Revenue Service, we talked a little bit about the Schedule F tax forms and their role in this product, and some various other things here. Purchase for resale is something we didn't spend a lot of time on, but those are the commodities that maybe for a direct marketer that you need to purchase, maybe some cucumbers or whatever to fill out your fruit stand, your vegetable stand, because you don't actually grow those for yourself, but you want to offer a wide range of products for your customers. Sales closing date, that's the date that you need to have all of the documentation submitted, your application, your intended farm operation report, etc. Special provisions, that's where you'll go on RMA's website to the actuarial information browser. These are the county-specific language, policy language that you'll need to be familiar with, and your agent will help you out with that. The whole farm history report, and we really talked about that on Tuesday, and then WFRP, I'll be using that acronym quite a bit. That's whole farm revenue protection. We had a graphic in the previous presentation that told us when our intended farm operation report was due, revised farm operation report, and our final farm operation report. This is a different look at the insurance cycle. The application, acceptance, approved revenue. That's our whole farm history report and our intended farm operation reports that are due at sales closing. So you bring all this information into your agent. They review it, make sure that it has all the documentation they need. If they need more, they'll get it from you, and then it's submitted to the company. The summary of coverage and then premium billing. The summary of coverage on this product happens similar to other federal crop insurance products, that after the acreage reporting date, and that's when the revised farm operation report is due, that's when we'll see what you've actually did on your farm, so that we can determine from that when the premium billing will be based on. Total production and final revenue, that is at the end of the year or at claim time. There's some language in the policy that you will need to be familiar with when that report is due, but basically that's giving us what happened on your farm. Probably you'll need to do some ending inventory that'll help you out with that. And then the claim for indemnity process in this product could happen at any time during this whole insurance cycle. Maybe as cause where something happens early in the year, like in this part of the country, we'll have winter wheat that was planted last fall. It may not make it through The winter comes out, it may or may not come out of dormancy, and that's something that we need to let our agents know that we got some winter kill out there. So it could happen at any time during the year. The WFRP application. It depends on what type of filer you are. And if you're a calendar year filer, that makes it easy because your calendar year runs from January 1 to December 31st. Everything lines up pretty easy. Early fiscal year tax filer, that's a tax filer whose fiscal year begins prior to the 1st of August. And then a late fiscal year tax filer begins August 1st or later. You'll want to make sure that when you visit with your agent, that if you have other insurance in force, you need to be sure to let your agent know that up front. Don't like surprises later in the year. Insurance that may be obtained from FSA, so if you have some NAP coverage or anything like that, livestock coverage from one of the various livestock offerings out there by FSA, you'll need to let your agent know that, and any crop hail insurance. And then finally, you need to identify the county where the majority of the total expected revenue is produced. Whole farm is a little different than all of the other different federal crop insurance policies, because most of the other policies are county-based. Whole farm covers, as we discussed on Tuesday, 100% of your farming operation, and many farming operations. Okay, sorry about that. I got muted and then got unmuted. The county where the majority of the total expected revenue is produced, you'll need to let your agent know that also. The entity structure, this is vitally important. You need to be sure to inform your agent of any related entities, either that you own or that you have an interest in, and especially important if you have a vertically integrated operation. So the application due dates, let's take a look at these. For a calendar year filer, tax year is January 1st to December 31st. The application and all applicable forms that we talked about on Tuesday must be submitted on or prior to the sales closing date that falls in 2019, or March 15th for Pennsylvania. The early fiscal year filer, that is where the tax year begins prior to August 1st. So we have, say it's tax year August 1st to July 31st, the application and all applicable forms must be submitted on or prior to the sales closing date that falls in 2019. Again, that would be March 15th. The late fiscal year filer, and if you're one of those, pay attention here because it's a little different. Let's say your tax year is September 1st to August 31st, September 1st, 2018 to August 31st, 2019. So immediately you see something that raises a flag. September 1st, 2018. The late fiscal year filer for the 2019 year has already started. So we're looking at something that's going to create an issue as far as the application, in that our next opportunity to apply for coverage won't be until November 20th. And I've got a little chart here for the late fiscal year filer. This is something I created to keep myself straight on how we're going to, how the tax year falls with the policy year for late fiscal year filers. I wouldn't expect that you grasp this, you know, on this first viewing. You'll have to sit down and look at it. But for example, let's just go down to the 2018 year here, because we're September 1 on the previous slide. Our policy year for 2019 had already started, and take a look at that and see how they line up. So September 1st is our beginning of our 2019 policy year, but it's our 2018 tax year. So your next opportunity to sign up for whole farm revenue protection won't be until September 1 of 2019, the calendar year, so to speak. So you got a little time here there to kind of watch and see how this product would work for you. So to apply for whole farm insurance, You must be a qualifying person in accordance with the policy with an interest in the revenue derived from the commodities to be insured. Your name on the application must be the same person as the person that filed the income taxes with the IRS for the tax year. So you'll want to make sure that your agent knows that the name that you put on the application, and you can show that it's the same name on the taxes. The application must be signed by the person to be insured or your authorized representative. Section 16G of the policy spells out the requirements to use another person's tax records. The main requirements are that you obtain at least 90% of the other person's operation, including the land and facilities such as irrigation and equipment systems, greenhouses, and other facilities. For each year of the other person's tax records that you intend to use, the other person must have had an insurable interest in all commodities produced on the farm operation you obtained. If this situation applies to you, be sure to work with your agent to make sure you know all of the requirements. This slide kind of goes through what kind of a high level what the policy says. You must be a U.S. citizen or a resident. You must be eligible to receive federal funds, file a Schedule F or a substitute Schedule F to the IRS covering 100% of the farm operation. The substitute Schedule F is for entities that may be filing other tax forms or that the IRS does not require a Schedule F for. So the entity must have 5 returns for 5 consecutive years. The policy does make exceptions for beginning farmers and ranchers so that we can build a whole farm history. Must be engaged in the business of farming and derive revenue from the production of commodities. And if you inherit, purchase, or lease another person's farm operation, the discussion I just had with you about obtaining 90% of the other operation is something that the policy requires. And then finally, if you do have a lot of commodities that are purchased for resale, you cannot derive more than 50% of the expected revenue from those commodities to be eligible for whole farm revenue. So again, getting back to the application here, ineligible operations. It is important to understand the limitations of this coverage. On this slide is detailed the coverage limitations that would make the farming operation ineligible. 2 things of note. The potato limitation is a legislated requirement, and that's under 508A3C of the Insurance Act. And if you have a CAT policy, whether there is any planted acreage being covered by the policy or not, the farming operation is ineligible for whole farm coverage. And what I mean by a CAT policy is if you have another federal crop insurance policy, say covering your corn crop, and you also have a whole farm policy, the policy covering your corn that is not the whole farm policy cannot be at a CAT level of coverage. That is a prohibition in the policy. Even if you have a CAT policy that is not in force, it needs to be canceled before you can have the whole farm policy. Again, it is very important that you discuss your entity structure with your agent if you have any of the situations listed on this screen. If it is determined later in the year that you are not a qualifying person or that your farming operation was ineligible at the intended farm operation reporting date, the policy will be voided and no coverage will be provided. Be sure to discuss this with your agent if you have any questions. The whole farm application, just wanted to reiterate from the previous webinar, we discussed these reports which need to be submitted to the agent as part of the application. Over the next few slides, we'll look at what the policy defines as allowable expenses and revenues and the adjustments made for whole farm revenue protection purposes. So allowable revenue for whole farm purposes is limited to revenues from commodities produced or purchased for resale that you have an insurable interest. The allowable revenue for whole farm is limited to the revenue from the sale of animals and other commodities purchased for resale, less the cost or other basis of such animals or commodities, And that's found on line 1C of Schedule F. Want to make sure that we include revenue from CC loans forfeited. And the thing with CCC loans, you'll need to, if you have anything along those lines, any revenue from CCC loans, want to make sure that you sit down with your agent and be sure to explain which loans are for insured commodities, because we're only going to count any revenue from insured commodities related to CCC loans. Want to make sure that the sale of animals, produce, grains, and other commodities were raised. That's found on line 2 of Schedule F is accounted for. And the taxable amount of total cooperative distributions, that's found on line 3B of the Schedule F. And again, we only include those that are directly related to the sale of insured commodities. For claim purposes, again, the cooperative distributions related to the sale of commodities produced in the insurance period. And why that is important, we aren't going to include any cooperative distributions that are attributable to commodities produced in other insurance periods. So you may have a commodity that was produced maybe in 2018, 2017, 2016, in which you're continuing to get distributions on. For claims purposes, we're not going to count that revenue against you. Other revenue reported on line 8 of Schedule F. We want to exclude the federal and state gasoline or fuel tax credits or refunds, but we want to include all revenue directly related to the production of the commodity that the IRS requires you to report. And this could be revenue from bartering, payments from buyers for bypassed acreage, and so on. So allowable revenue, what does this term mean? Perhaps this is a good spot to back up and explain the role of allowable revenue has in determining your whole farm guarantee. The policy defines what revenue will be included as insurable as reported on your Schedule F and what will not be included as insurable. As we learn in the few slides later, revenues that compensate you for a loss of revenue are excluded from coverage. For example, indemnities received from other federal crop insurance policies will not be included in determining your guarantee. So without going into a great level of detail on each of these items, it is important to understand that your agent will need more information than what is found only on the Schedule F or substitute Schedule F. The allowable revenue worksheet is the document that the adjustment to the amounts found on the Schedule F are recorded. The adjustments listed on this slide are done for the current policy year and every year in the whole farm history report, period. That is very important to remember that. Just looking at this slide, you might take a little time to read that before we move on. So post-production operations. That is the value added to commodities or commodities in which you don't have an interest, custom hire or rental activities, cooperative distributions not related directly to the sale of an insured commodity, earned as an income earned as an animal contract grower. So if you've got a feedlot and you're feeding other people's animals, you're acting as a contract grower. So that's all the kind of things that you need to make sure that your agent is aware of. Wages, salaries, tips, cash rent, rental of equipment or livestock, supplies, government ag programs, including NAP, federal disaster payments, and repayments. Uninsurable commodities and commodities not grown in the United States. So if you got you're up in Pennsylvania, I'm not sure what the opportunity is to have some land in Canada that you might be growing something, but in the Midwest, up in the Dakotas, maybe Montana, that sometimes happens where there'll be some revenue from some land up in Canada. So remember what the slide says. These are items that are excluded from allowable revenue. So the next bullet there, these are also some things that are not included in allowable revenue, but however, they are included in revenue to count for claims. The net gain from commodity hedging or speculation, value assigned for uninsured cause of loss, or abandoned acreage, accrual adjustments for beginning and ending accounts receivable and inventories, federal crop insurance indemnities, or prevented planting payments or another federal crop insurance indemnities. So this gets into the discussion of what, looks like I've got a message, but let me finish this thought. This gets into one of the principles of insurance. One of the principles of insurance is that you not be over indemnified for a loss, an insured loss. So the whole purpose of whole farm insurance is to make you whole and not to profit from it. So let me see, looks like we've got a chat or a question coming up here. Let's see if I can read this. Can you all hear me right now? Okay, looks like we can hear me now. All right. So let's move on to the next slide. So what is the role of expenses in the whole farm determination of your guarantee? So to reiterate, the coverage provided by the whole farm policy is only provided against a loss of revenue that you expect to earn or will obtain from commodities you produce or purchase for resale during the insurance period. Nowhere in that statement does it say that we're insuring you against excess or expenses that you incur that are over and above what you otherwise would have realized. We're only looking at the revenue. So for example, if for whatever reasons your expenses fall more than 30% from the approved revenue or approved expenses determined and reported on the farm operation report, at that point, the insured revenue will reduce it 1% for each percent of actual expenses that fall below 70% of approved expenses. In other words, there's a 30% cushion for variation in your expenses before your guarantee is reduced. So essentially for expenses that are not incurred, understand that could happen if you have a commodity that is damaged. And the policy does take into account that commodities can be damaged and gives an allowance for that occurrence. So whole farm is not designed to guarantee a margin of profit. So that's important to understand, and that's why expenses have the role that they do. So for the example, I gave you an example here. Let's say our approved expenses are $115,500. Our insured revenue is $325,000. Our actual expenses end up being $75,075, or 65% of approved expenses. So right there, we're below that 70% threshold by 5%. So we take that 5%, our insured revenue is reduced 5% for claim purposes. So 100% minus 5% equals 95. 325,000 times 90 for 5% equals $308,750 insured revenue for claims purposes. This $308,750 is what we will measure the revenue that you've earned for the year against when we get to a claim. So the purpose of allowable revenue and allowable expense worksheets is to identify revenue and expenses directly attributable from the production of insurable commodities. You will need to provide your agent documentation such as sales receipts, purchase receipts, etc., that explain what went into the numbers reported on the Schedule F or substitute Schedule F. As you can see, the list of allowable expenses is extensive, and we don't have the time today to analyze each and every one of them. Work with your agent to complete the allowable expenses worksheet and bring out the details of allowable and excluded expenses. The commodity count. What is the commodity count? The commodity count is a measure of the farming operations diversification. a common saying in the investment world is, and you've probably all heard it, don't put all your eggs in one basket. In other words, utilize multiple investments to reduce your risk in the event one fails. The same is true in farming. Increase diversification to reduce risk resulting from the loss of a single commodity. In an earlier slide discussing the application, it was discussed that the farming operation is not eligible for coverage if the commodity count equals 1 and potatoes are the only commodity with expected revenue exceeding the qualifying revenue threshold, or revenue protection is available under another federal crop insurance policy for the commodity with expected revenue equaling or exceeding your revenue threshold. So in the previous webinar, we touched on the role of the commodity count in determining the coverage levels that the farming operation qualifies for. Included that chart again on the next slide as a reminder. So let's take a look at this chart. So as you can see, the basic subsidy qualifying commodity count of 1, look across the top of the coverage levels and it shows the subsidy levels of premium. Notice that the 80 and 85% coverage levels are not available here. Going down, we're looking also at the commodity count of 2. And again, although the premium subsidy level went up, the 80 and 85% coverage levels are not available. But then when we get to a commodity count of 3 or more, the 80% subsidy level is present through the 75% coverage level. But here you can see now you qualify for the 80 and 85% coverage levels. So the more diversification, the more premium subsidy credit is given. The whole farm policy provides protection against the multiple perils resulting from natural causes. The causes of loss for whole farm mirror the causes of loss protected against for most other federal crop insurance policies. It is important to keep your agent informed of damage that could result in reduction in approved revenue. It is vitally important to maintain documentation to support the reduction in revenue from insured and uninsured causes. In the previous webinar, it was discussed that the company needs to be afforded the opportunity to inspect a damaged commodity or commodities before you dispose of, destroy, or harvest the damaged commodity. And I can't state that with enough emphasis. I'll draw your attention to the last bullet on the slide. There is one exception that if you had a policy the previous year, this policy does provide some carryover insurance for losses that might have occurred in a previous year. So maybe you had a late fall freeze to a perennial crop that affects the bloom this year, that would be covered. The exception to the carryover aspect of coverage is that if there is a reduction in the water supply that was known at the time or should have been known, that is one exception to carryover coverage. So this is a long list and it will continue for a couple more slides. The causes of loss that are not covered under whole farm. The cause of loss on this slide and has kind of truncated them somewhat for brevity. The intent is to create awareness that not all causes of loss that result in a reduction of revenue are covered by the whole farm policy. Again, it's important to keep your agent informed and maintain documentation to support the reduction in revenue from insured and uninsured causes of loss. So here's the first 7 in the list of not covered losses. Here's the next few. I want to point out that whole farm is unique in that it may be the only federal crop insurance policy that allows for the abandonment of an insured commodity. But beware that if you have other federal crop insurance, that policy may not allow such abandonment. So perfect example, you have some wheat. It's been hailed on to the point that it would cost more to harvest it, to take it to market, and other persons or other farmers in the area no longer are caring for the commodity to take it to harvest. You want to make sure that on your other insurance policy, you may have to continue to maintain it and things like that. So want to make sure that you check with your agent before abandoning a commodity or destroying it in that situation. So again, the company must be afforded the opportunity to go out and give you consent to do those kind of things, especially if you have another policy in force. Finishing up the list, a couple of things to point out here. Failure to obtain a price for any commodity that's reflective of the local market value. Do your best effort to market the commodity. Any deterioration of commodities in storage that reduce the quality or the value of the commodity, unless due to insured cause of loss that occurred before the commodity was harvested. So insurance coverage, the policy states that coverage ends at harvest. That's pretty typical of any federal crop insurance policy. There are a couple that have endorsements that have storage quality or storage quality and storage deterioration, maybe a potato policy or something like that. But you want to make sure that once that harvest happens, make sure that your agent is aware that there may have been any damage out there. The company would probably come out and inspect it to verify it and document it. Another point here on 15, if there's no verifiable market for the commodity that you're producing, or the amount produced exceeds the amount of production that could be expected to be received by the market under normal growing conditions, that will be a cause of loss that is not covered. So you have a contract for 100 bushels of something, you plant enough acres to produce 500 bushels, well, you're built in 400 bushels there that probably does not have a market. The loss of revenue for those 400 bushels would not be covered. Expected values. This is one area. The expected values and expected yields is probably where you really need to work with your agent, provide all the documentation. That's basically if you're wanting to go get a loan, those kind of things, it's the information your banker probably would want also. So the expected values and yield sections in the policy provisions and the underwriting instructions that the companies are to follow are much more extensive than what I put on this slide and the following slides. Again, it's very important you provide your agent a thorough explanation and thoroughly document your expected yields and values. So you look at the slide here. The expected values are the price of the commodity that you can expect to receive when the commodity is harvested, and we're going to base that on the following. So if you have a marketing contract, the price is probably stated in there. We'll use that. If it's not, we're going to, any price received. Well, if you sell the commodity prior to the intended farm operation report, we're going to use that for inventory purposes. So for example, you have a commodity that you sell in February, you don't put your farm operation report into until March. Well, we know we've got a known quantity, we have a known price, so that just stands to reason. And then finally, the price that the AIP, the company, agrees best reflects the price you can receive for the market where your commodity will be sold, obtained from the most applicable source for your farm. In other words, you need to have the documentation that your agent agrees that reflects what you can receive. We'll get into more what that is later, that the company accepts. So the applicable sources for pricing commodities, there's multiple sources here. They may be the prices reported by the Ag Marketing Service, National Ag Statistical Service, or the Economic Research Service, or any other governmental agency. Could be that the FCIC published price for the area where you normally sell the commodity might be the most reflective of the price that you could receive. The current local average cash bid price for the commodity in the area where you normally sell the commodity. This may be a situation where you need to apply a basis to the commodity for your area. And then finally, average price offered by at least 3 commercial buyers, or 2 commercial buyers, I apologize, that's a misspelling, we'll correct that. And 1 selected by you and 1 selected by the company. if none of the other sources are available. And then finally, prices from a reliable third-party source that the company approves, such as a commodity broker, crush district, packer, processor, or marketing cooperative. So multiple things to choose from there. So if none of those disinterested third parties that we just talked about exist for the insured commodity, then we may need to look at the average price you receive for the 3 most recent years, and the company will adjust those to reflect local market trends. So again, expected values must be reasonable, realistic, and consistent with the available local market information. Want to document that. Again, verifiable records, direct marketing sales records for direct marketed commodities. We must take into account current local markets, cycles, and trends. So is the market going up? Is it going down? What do we think it's going to do? How do we document that? Exclude post-production operation expenses, and just spend a little time here on what those are. Those are the expenses that after the commodity leaves the field, leaves the farm, delivered probably to another third party like processor or whatever, the expenses for that processor would be considered post-production. Now, the included market readiness expenses, this is something that was included in the 2014 Farm Bill, and the term leads to a lot of confusion, but what they mean by this, the market readiness expenses, are those expenses that are difficult to separate out, and the commodity or specialty commodities are what the writers of the Farm Bill had in mind. So, for example, lettuce that is picked in the field, delivered to the side of the field, maybe where it's washed, put into a sack, put into a box, and then loaded onto the truck. It's kind of all rolled up into the harvest process before it's actually delivered to market. And then finally, if we've got any commodities that are purchased for resale, we exclude the cost. So getting back to my farmer's market example, you bought some cucumbers, maybe you sold them for 50 cents a piece, you paid 40 cents for them, you want to remove the 40 cents. So your value is 10 cents of revenue. Now, for vertically integrated operation, we need to make sure that you document that your any expected values are consistent with the values obtained from objective sources. So what are other producers that aren't vertically integrated? What are their costs for those things? Any post-production operation expenses, again, are to be removed from the values. So reading from different sources, perhaps if you're growing some grapes, and those grapes are put into wine, the cost to make those grapes into wine would be post-production expenses that need to be taken out. And then finally, the market readiness expenses can be included, but they must be customary and reasonable and comparable to disinterested third-party costs. So you can see how you and your agent will get to be very close in deciding all these different kinds of determinations. So this is a high-level look at the criteria that you and your agent will need to discuss and document in determining an expected yield for an insured commodity. So just to reiterate, we've moved over from values to yields. We must determine for each commodity an expected yield. And it goes a little further. If you have different types of commodities that have different yields, you probably want to list those on a different line of the farm operation report. You want to make sure that you document that it's a yield that you can expect to produce under normal growing conditions. So that's why we look at an average in your whole farm history to get an idea of what you can normally expect. They must be realistic, reasonable, and consistent with available local agronomic information, supported by verifiable records, and for perennials, reflect any alternate bearing or downward trending tendencies of the insured commodity. So some commodities, some older varieties of apples have on years and off years, and we want to make sure that we take that into consideration. For commodities insured under other federal crop insurance policies, we're going to first look at the actual production history under that other policy, and we're going to use that in most cases unless you can provide documentation that the company, the AIP agrees, demonstrates a higher or lower expected yield than that actual production history. So for example, if the years prior to the whole farm history period in your APH database, your actual production history database, and if you've got a 10-year APH database, the years prior to your whole farm history, if they do not reflect the yield that you can expect to produce during the insurance period, and the AIP agrees that the years prior to your whole farm history period are not reflective of the yield you can expect to produce, then they can make an adjustment. So you may have gone from conventional farming to no-till or reduced till or something like that, and you saw the benefits of that, and increased production has been reflected in your history. So there's all kinds of different things. Every farm is unique. There's not a one solution for everybody, so that's why you need to discuss it with your agent and keep them informed. So again, finally, if you can provide documentations that changes in your production practices during the insurance period have occurred and the company agrees, demonstrates a higher or lower expected yield than the APH. So in some cases, this may be subsurface irrigation or some other changes like that. Continuing on with expected yields. So for highly diversified farms, there will be many insured commodities that may not have another federal crop insurance program from which to draw yield information from to establish an expected yield. It is important to note if a commodity insured on the whole farm policy is not insured under another program, but another program is available, the FCIC published transition yield will be the first source that the company will look at to establish a yield for the commodity on your farming operation. So I just kind of broke this down into a couple of areas here. Commodities not insured under another federal crop insurance policy, how we're going to determine your expected yield, what it's based on. And then finally, if we've got 3 years of records that are not provided, we're going to make a determination based on this hierarchy listed below. So the FCIC published transitional yields, yields published by other USDA programs, and yield information provided by participants in the cooperative extension system. However, we're not going to include university trial data or budget reports that you may find on their websites. Verifiable records. We talk a lot in the policy and throughout other policies of the Federal Crop Insurance Program. It's this term shows up a lot in all of the procedural handbooks that companies are asked to follow or required to follow. But let's just read it here to make sure that we all understand what verifiable records are. Verifiable records are contemporaneous records provided from a disinterested third party, such as records from a warehouse, processor, broker, packer, input vendor, etc., or by measurement of farm stored commodities. Except for commodities sold through direct marketing, if you process or pack your insured commodities, you must provide final settlement sheets showing disposition of the insured commodities and marketing records reconcilable with revenue reported for tax purposes for your farm operations. So why do we exclude direct marketing? Well, if you're direct marketing, you're not dealing with a third party and you won't have final settlement sheets from them. So that's why we have a couple of aids later on, let's just say documentation aids that RMA has provided for you. So this is not an exhaustive list of every situation that will require you to provide verifiable documentation, but it's pretty complete. This list is only intended to alert you to the types of information your agent or company may require that you provide. The company may require additional verifiable documentation depending on your farm's unique circumstances. Be sure to ask your agent to explain the record retention requirements of the policy. That's something that I didn't go into very much, but all federal crop insurance policies have a record retention requirement, and you must know what that is. So talk to your agent, have them explain it to you. I've talked about these two record-keeping aids a couple of times. The risk management agencies develop these forms for direct marketed commodities in an effort to provide a format to collect sales information. These forms can be found on the RMA website, and simply just click on the whole farm link found on the front page of RMA's homepage, and you'll be able to get there. These documents by themselves, however, are not sufficient to support direct marketing sales. Dated daily receipts, dated photos, published marketing materials showing prices, etc., are some examples of supporting documentation for direct marketed commodities. So we're going to jump into kind of bringing everything together here. Got a simple animal inventory example, some livestock, just to show how the inventory works in determining revenue to account for claims. So the background here is we have a 50-head cow-calf operation that carries over calves to be finished out in a feedlot, and they'll be sold in April of the following year. They're also going to purchase some feeders throughout the year to be finished out in a feedlot. So let's take a look at our form here. This is our inventory report that came in with the application. So you can see here we have some heifers and steers. These are the ones that came over or carried over from last year. Raised them on the farm last year. They grew to an average weight. See, the heifers, we've got 800 pounds, the steers 900 pounds. And we've got the average value at the first of the year or the beginning day of our tax year. So for those of you that may be in a fiscal year situation, that would be the beginning of your fiscal year. Again, work with your agent on that. So on our intended farm operation report, what do we want to put on there? We're going to talk about something here that you'll need to make sure that your agent is aware of. But there's a couple of concepts in the information on this slide. First is the recognition that livestock operations typically don't experience 100% success rates for producing offspring. So you'll need to let your agent know or bring in some historical records to establish an expected yield based on conception rates, weaning rates, and all that kind of stuff that goes into growing livestock. The second concept is that whole farm covers only the revenue from the expected growth of the animals during the policy year. The expected value at the time of sale for the heifers and steers will be determined on the intended farm operation report, and from this value, the value of the animals at the beginning of the policy year will be subtracted. So our inventory report established what that beginning value will be. So we've got our cow-calf of 48 head, that's 50 cows. We had a 96% calving rate. 96 times 50 is 48. So that's what we expect that will be produced on the farm. Our carryover heifers born last year, we got the 25 head, and we'll subtract that beginning value that was reported on our inventory report from what we expect to sell them at. The carryover steers, will do the same thing for them. So here's what it looks like. We got our cow-calf, we got operation here, we got the yield of 800 pounds, $1.30, expected revenue of 1,040 times 48 calves, and we expect revenue of 49,920 when we sell those. The feedlot head, the carryover ones with 1,100 pounds, and it just kind of works through. Now notice that we purchased these, and we've got a cost basis of $57,500. I want to back up a couple of slides. Actually, that's these two numbers added together. It's the 26 and the 31,500 added together. So you can see that's what our beginning amount is. Right there. So here's our 50 head times our 96% calving rate, our intended quantity. These are 25 head of steers and 25 head of heifers to be finished out at the feedlot. And then our 57,500 carryover from the farm or the beginning inventory. So now we get into our next step of the process during the year. Come July 15th, we need to submit a revised farm operation report. We're going to carry the values over on the cow-calf line and the heifers and steers to the revised. No changes happen, so we're going to move those over. The insured purchased an additional 30 head of steers at 900 pounds on July 5th for $33,750. We're going to finish those out to 1,100 pounds. So we want to add an additional line for those 30 head. So this is what it's going to look like. So let's get to the revised section. We're going to pull over the information on the first line, just bring it right on over. No changes, we're done. Same thing here on the second line of the revised section. Now let's get to those 30 head of cattle that we're purchasing. So we've got feedlot cattle. We're valuing them by the head. Their yield, we expect to sell them at 1,100 pounds for $1.30. Just carries right over. Now, you notice we jumped from the intended over here to the revised because this happened after we initially submitted our application and our farm operation report. So right here, these items are going to be blank. So we jump right over here to our revised time. Bought these on July 5th. We paid $33,750 for them. That's our cost basis. Multiply that out, subtract out the cost basis, and we end up with our expected revenue of $9,150. Notice here how these numbers are different now. Our revised amounts are going to be different than our intended amounts. We bought something that happened. And again, I mentioned this on Tuesday that anytime there's any changes, you want to make sure that you're keeping your agent aware of it. So along those lines, made some decisions. We're going to keep 4 of those heifers back as cow replacements. So we're going to make a revision again to our farm operation report. We're going to take those 4 heifers out, reduce from 48 to 44 head. I'll show you that on the form. We also decided to take one of the steers, put it in our own freezer. So we're going to make that revision also. We received the sales receipts, the company did, for the carryover steers and heifers, and that revenue showed up on Schedule F, so that's good. And then we also received the sales receipts for the purchased steers, and that showed up on the Schedule F. So at claim time, we get to claim time. The end of the year average weight and value for the calf crop is 44 head at 850 pounds for $1.30 a pound. We're going to account for these values for the current calf crop carried over to the next year on the Indian Inventory Market Animal Report. So we'll show you how that's looking here. So here's our form. Notice that I blanked these out because we had those changes. So we kept back the 4 heifers as replacements. So we subtract the 4 out. Now our amount is 44. And then just do the math. Same thing here. We had the 1 steer taken to butcher. Reduced the cost basis there by the 1. And want to make sure that we do the math there and carry everything through. Notice the difference here is how this is going to work through the form. So this is the amount that premium will be based upon for the year. So said earlier in an earlier slide that at revised time or acreage reporting time, if you will, that's the time that we'll base your premium on in the insurance cycle. So here's what our Indian inventory report's going to look like. Carrying over those that we raised this year. We've got 4 replacement head here. So notice this number really didn't change because we just replaced them. The one thing that you want to take out of this is this example illustrates accounting for breeding inventory separately from the livestock that will be sold and reported as revenue on the Schedule F. Sold breeding stock is normally considered the sale of an asset and is not insurable under whole farm. So want to make sure that that's something that a concept that you're familiar with. To read in the handbook on the breeding stock, breeding animals that are produced on the farm or purchased as assets are accounted for using the breeding animal inventories form, which we just showed you there. Sales of breeding stock, including culls, are normally reported on a Form 4797, that's sale of business property. So these are items that aren't going to show up on the Schedule F and should not be. However, there may be instances where the culls are placed in a finishing operation and may be reclassified as market animals. So any culls that are reclassified as market animals and the sale of such animal, and it ends up being reported on the Schedule F, we need to make adjustments to this beginning inventory and the farm operation report. Otherwise, the sale of the breeding animals or culls that is reported on the Form 4797 are considered uninsured animals and not included as revenue to count. So continuing on with our example, our calves that are expected to be produced next year, just do the math to get our ending inventory. So in this scenario, our ending inventory is less than our beginning value, indicating that there's an amount attributable to a prior year. In a previous webinar, we learned that adjustments that reduce revenue to count for claims purposes or increase the potential amount of a claim. Without the adjustment, revenue to count for claims would be overstated by the 8,800. So let's look at our numbers. We're going to be down here on the bottom of the form. So we're going to take our ending inventory minus our beginning inventory, and this is the amount of adjustment for our claim. So you can see, if we didn't have this form and have the information on this form, the inventory adjustment would not be done, and we would be understating your claim by $8,800. So this really brings together the importance of thoroughly documenting what's happening on your farm. Any questions? That concludes my portion of the whole farm presentation. Hope you got more out of it than what you came today with, and it helps you out. Any questions? Just moving on, seeing no questions, I'll just leave you with some parting thoughts. The RMA website, just so that you're familiar with it. This is the address. The whole farm revenue protection link is right there. That'll take you to the whole farm revenue protection page. The other thing I want to point out on here is how to find an agent. I keep talking about working with your agent. And this is the RMA locator where you find it. Looks like we do have a question that came in. Let's see. Okay, the question was, what was the cause of loss in my cow-calf example? Essentially, the adjustment was made to reduce our revenue because we reported a revenue amount. We sold them for, I believe, less than what we originally thought we would. So it was a price decline. And let's see if I can can the grain. Can grain for resale be insured for whole farm revenue protection? Typically, if you're purchasing the grain for resale, depends on the end use of it. If you're adding it to a quantity so that you can add it to your amount you're offering, typically it can. You have to remember that you separate out the purchase cost of that. Again, that's one of those things that you'd have to spend some time with your agent to say what the purpose of the resale of the insured grain is for. You know, are you purchasing it so you can fill a marketing order? Probably not, because you would have realized a loss on your lack of production. So it all depends. Yeah. Okay. All depends on what? It depends on, are you using it to replace a commodity that you lost? That's what it depends on. Are you purchasing it for purposes of reselling it as part of your operation? Hopefully that helps out. Any other questions? Yeah, any commodity that's purchased in a prior year that ends up in ending inventory would show up as a beginning inventory, if that's what the question is asking. Yes, because any inventory that's on hand at the time, you want to make sure that we account for that because we don't want to count it against you when the claim time comes. Because it would be inventory attributable to a prior year. Okay, just leave this open for a little bit longer. So the question is, how do we get resale value projections? That gets back to the expected values section of the policy. When do you expect to sell it? What the market indicators are? You know, what do the futures markets show for that corn? What's your local market projections? That type of thing. So that is one of those questions that can't answer in a webinar like this, because you have to have, you know, local information. You go look at the different sources that are listed in the policy, whether that be the FCIC price, the futures market price for the market month that you're wanting to sell it in, and those type of things. However, just looking at that inventory, you know, we're going to value that on the last day of the year. That is like I said so many times, work with your agent on that one. Yes, how do we come up with a value for that inventory grain when sold? Well, we're not interested, if it's carryover from last year, it's in inventory, we want to value it on that first day of your tax year. So whatever that value is, that's what it's going to be listed as. And I think that gets back into the expected values and the section in the policy about inventories. So the question is for when it is going to be resold. That's like any commodity that's going to be resold. If it's not an inventory product and we're going to make it part of our farming operation, when we're going to sell it, that is looking at the market indicators for the time that you plan to sell it. So if you purchased a commodity for resale, or you expect to purchase a commodity for resale, you put that on your intended farm operation report. You expect to sell it in August. What are the market indicators for August? If there isn't a market for that commodity, you want to look at the last 3 years of records for sales, if you have them, and those type of things, and try to project based on those sources. Have to document them and provide them to your agent what the expected value will be. Okay. Well, thank you all for your participation. Thank you for Lynette, Dylan, for introducing this and watching out for me on questions that are being asked. And is that, looks like we've got another question, and that's the joy of this product. There's never any end to the questions. So what happens with the grain purchase for resale in 2019 in all of this? I'm assuming from an inventory perspective, or did we buy it in 2019? We're going to resell it in 2019. If it's a product that's we expect to purchase in 2019 for resale, we put that on our intended farm operation report with an expected value of when we plan to sell it. And it just comes through when we get that revenue, it becomes revenue to count. Okay, one final question. Is that everything for everybody? Well, again, I want to thank you. Look forward to our next time that we have webinars, and we'll continue on with those. Thank you, everybody, and have a good day.